Now, one of the things that is kind of a double-edged sword, if you will, is the financialization of Bitcoin, right? So back in 2012 up till, let's call it 2017, 2018, it was pretty much, if you were into Bitcoin, it was, I don't want to say anti-Wall Street, but definitely had a different vibe, different ethos, a different community than a lot of what you see in Wall Street and traditional finance or legacy finance. There's been a blurring of that line over the last few years. Some of that is seen as a positive development, right? Getting more liquidity into the market, kind of more sophisticated players, a lot of the more significant analysis. You get kind of into mainstream press more, all that kind of stuff. There's also a concern, though, around the financialization of Bitcoin leading to a dampened upside potential. Because it kind of gets incorporated into some of those more legacy markets and asset classes and funds. How do you think about this, right? Like, what are the positives and negatives, and kind of where do you think that we come out on a net basis?
That's a great question. I think there's a lot of anxiety in this space around what happens when the institutions do come. You know, in late 17, we hypothesized that they would come a little bit earlier, and I do think they will come. As I see it as some sort of an inevitable thing that will occur. It's nothing to be afraid of. I think a lot of people look at this and there's this anxiety around, okay, what happens when Wall Street comes? This big evil Wall Street coming in, gonna mess with Bitcoin, my little cypherpunk, dream. And I don't think it's a bad thing. So, first and foremost, different financial instruments like futures, options, and lending and borrowing are all normal market activities. They enhance price discovery, they enhance liquidity, and they allow different operators in the crypto space, or in Bitcoin specifically, to hedge their risk. So this means that, potentially options have the ability to dampen, the downside risk for miners, which is a good thing. So maybe we have more continuous hash rate rather than difficulty adjustments that are lower difficulty adjustments. So, I don't think it's a bad or good thing. I think it's basically a market neutral thing. It's how markets work. They essentially allow the efficient price discovery. They allow market participants to hedge certain types of risk. All of the different financial instruments that I've seen come out, I think, are great for different operators. Like I said before, I think a big one that a lot of people have a sticking point with is lending and borrowing, because people go, oh, fractional reserve lending is bad. And I say, well, how much is bad? So yes, fractional reserve banking has led to what we've seen, different bank issues over many times over the last 400, 500 years in terms of all financial recorded data. We do see that after a decade or two, we typically have like bank runs. People go to their bank, the bank has done fractional reserve banking, and their money may or may not be there. Fractional reserve banking in and of itself is not a bad thing. The bank compensates you for that risk by offering you an interest rate. You should be evaluating the different risks that the banks in which you deposit your coins at or deposit your money at. You should be evaluating the risks in which you are being compensated for with that interest rate. Banks serve a good function in the economy, which is to lend money to individuals who don't have that money now, whether that be your personal home, personal car, or business. These aren't bad things. Loans and lending and borrowing is not a bad function. When we do too much of it, it becomes a bad thing. And so I think Bitcoin at that base layer, having only 21 million Bitcoins, that immutable monetary policy where it cannot be changed, the settlement and custodial guarantee that you have when you hold Bitcoin yourself, that's phenomenal. I think that alone is a huge breakthrough in the world economy. And so, yes, if you choose to take on more risk and give your coins to different lending companies out there, you're being compensated for that risk. Now, is 3, 5, 6% enough? I don't know. That's a subjective thing, but I don't think it's an inherently bad thing.
Yeah, and I guess this kind of leads into another aspect of the financialization is you get more sophisticated players that come into the market. They have that experience from various asset classes. And there's a lot of people who say, look, these markets are incredibly manipulated, right? There's whales out there. These people know what they're doing, and they're able to increase and decrease price through manipulation. How do you think about that? And do you think it's a fair accusation to say that those are the sophisticated non-Bitcoin type audience doing that? Or do you think it's maybe kind of everyone in the market?
Yeah, so the concern over whales, because we're all minnows and dolphins, as some people put it, we're worried about these whales splashing around and causing these really intense price gyrations. Whales have been a concern since 2012. I remember a lot of the Bitcoin talk there. I think there's a Wall Observer is one of the oldest threads on Bitcoin talk, where people talk about giant bid or ask walls, where a whale will go put a giant wall in to kind of scare the market. The most famous one is called the bear whale. This is from 2015. I think an individual put in a $30 million sell wall that was eaten by Bitcoiners. And it's a famous day where we slayed the bear whale. So if you Google the slaying of the bear whale, that's when the Bitcoiners all came together to slay that bear whale. As Bitcoin has increased in adoption in terms of number of hodlers, liquidity, what I mean by that is the bid-ask spread, the depth of the order book, and volume. As those have all increased, so you have more market participants and greater liquidity, the ability for a whale to influence the market is diminished because there are more market participants that they have to fight against, which would be, I guess, what you could call maybe like a true price, a price minus the influence of one single participant. Every market has large participants. You have tech companies where founders hold 20, 30, 40% of the company. You have different types of commodities where a certain investment bank or a hedge fund might own a large percentage. We cannot control who owns X percentage of Bitcoin. As the markets become more liquid, those large hodlers of Bitcoin will be able to influence the price less and less.